Good afternoon, everyone. On behalf of myself, Carl Rootsman, and my team at SPW, a warm welcome to all our clients to this first webinar of a series of 3 webinars. It's good to be with you. It's good to connect with our clients again, and I hope you enjoy this series of webinars. Why are we doing this webinar, and why we think at Sanlam Private Wealth we're incredibly well positioned to talk to you about this? I think there's a couple of reasons. The first reason is we are the second largest wealth management and private client business in South Africa, with more than 100 billion rand of assets that we manage for our clients in South Africa and globally. And of that 100 billion rand of assets that we manage on a full discretionary basis, more than 50% of that is today is offshore, and we manage that out of our office in London. And if I look at the trend, so we see more and more money moving offshore. That 50% a couple of years ago was 35%, then 40%, today nearly 50%. And I think if we fast forward 2 or 3 years, probably will be more than 60-70% of our assets will be managed offshore. But I do think that most of you have exposure to our offshore capabilities and our team that sits in London. And the purpose of today is not to talk about that expertise, but actually the second reason why we're excited and feel we're best positioned to talk to you is the expertise that we have within Sanlam Private Wealth. So today we sit with a highly qualified, very experienced fiduciary and tax team. That team is headed by Stanley Brown, and I think many of you have met Stanley, Christine, Fane Corsi, Anton Muskovitz, and those individuals who do manage, provide advice to many of you today, set up structures for you, provide trustee services to many of your clients. And I think that team and that expertise is incredibly well positioned to provide you with advice also on how to go offshore, the structures that you need to invest in, and the different jurisdictions. I think the third reason why we're well positioned to talk to you is the infrastructure that backs up the skills and the experience that we have in South Africa. So today we sit with a wholly owned trust business, Sanlam Trust International in Mauritius, more than 50 people that work in that business. And we manage more than thousands and thousands of structures and thousands of clients who basically use that as a vehicle to take investments offshore and manage those assets offshore. And they provide advice, regulatory advice, and make sure that we manage the assets for those clients according to the mandates and the regulations. And then I think to add to that, we're also busy looking at another offshore jurisdiction. We do think that emerging market jurisdiction like Mauritius can be well complemented by another, what I call more developed market jurisdiction. So hopefully we will close out on a transaction within the next couple of months that will also allow us to provide exactly the same service out of one of the Channel Islands. So very, very exciting for us. And then I think lastly is just to back our investment expertise up. We also provide loan facilities to many of our clients in South Africa. So if you sit with a share portfolio and you don't want to realize those shares maybe for capital gains tax reasons, then we can provide facilities against those investments to allow you to diversify, or maybe diversify into other asset classes or purchase other assets. And the exciting news is that within a couple of months we will do exactly the same with all these offshore assets. We will be in a position to provide you with a euro, dollar, or sterling facility to leverage off the offshore assets that may sit in these structures. So I think without further ado, I would like to introduce you to Reggie Labuskaghni. I think many of you know very well. Reggie is head of our product and strategy within Sanlam Private Wealth, and he's going to talk to Nick about the offshore structures and what the best structures to invest in. I really hope all our clients find a lot of knowledge out of these sessions. And after these sessions, please feel free to talk to your portfolio managers, talk to the team, and engage with us as you go through this journey to start diversifying assets and invest money offshore. So, Reggie, looking forward to the session with you and Nick, and over to the two of you. Thank you.
So, as Carl said, we're kicking off a series of webinars. The first one is basically just a high-level look at thinking about how to choose the best structure for your offshore investment. So I know offshore investments has been a hot topic for South Africans for a number of years now, and there's a number of reasons which we'll get into in a minute or two. But the purpose of today is not talking about the investment strategies or how to invest your money. There's a lot of planning you need to do prior to going offshore. And certainly what we're going to discuss today is some of those things that you need to think about. But I think certainly something you're going to hear from both Nick and myself over the next couple of minutes, or call it the next half an hour or so, is certainly it all comes down to your personal circumstances, and you need to go seek advice. I know we've got a lot of our partners that are intermediaries themselves, financial advisors. So go speak to your financial advisor, go speak to a professional, and make sure you get the right advice before you go offshore. And just a brief intro on Nick. Some of you might have met him, some of you might not have met him. So Nick is a senior relationship manager at Sanlam Trustees International, which Carl referred to our Mauritian-based structure or trust company. So Nick is a CA, so a very well-qualified individual. He spent a bit of time at BDO Spencer before he took his family over to Switzerland in 2006, where he spent quite a bit of time with Stonehage, basically looking after globally wealthy individuals and helping them with their structuring there. He was there for around 5 years before he relocated back to South Africa, where he spent a couple of years with Geneva Management Group, and he joined Sanlam Private Wealth in 2017. So Nick, welcome to you as well. And I look forward to this, but I think let's just dive straight into this, Nick. So I think I know we're all saying it is a very important topic, but why is foreign investing and investing globally for South Africans such a hot topic?
Hi, Reg, and thanks very much for the opportunity to talk tonight, and thanks to everyone out there that's listening. As you've said, I mean, investing offshore is definitely a hot topic in South Africa, especially now. But I think the truth is that it has been a hot topic for quite a while. And the reasons behind that are quite a few, but I won't go into all of them right now. But coming sort of from the tip of Africa, where we are with a relatively small economy, and having not been able to invest properly internationally over many years, and investors look at that and they have a few reasons for wanting to go global. One of the main reasons is always to protect your wealth from both domestic political risk and economic risk. Another reason, which is fairly straightforward, but it's to be able to take advantage of investment opportunities and currencies that we don't have access to locally. And I think the final reason is really just to be able to invest diversely into different geographical locations and different opportunities out there. And all of this is really so that a wealthy family is able to maintain and grow their wealth in a way that is not just limited to the South African economy.
And also not to this first generation, so definitely for a longer period of time.
Yeah, look, I think anyone that's looking to grow their wealth through investments is looking further down the line and not just into their own generation.
And I think probably an important thing, because it's something we certainly, with all the scaremongering in the press, there's a lot of people, and the rand is probably the biggest emotional gauge in South Africa. As soon as it blows out, as we've seen recently, then everyone wants to ship all their cash offshore. And as soon as it strengthens, they want to do the opposite. We're certainly not advising taking all your money here and shipping it offshore.
No, absolutely. A balanced approach is key. There are a lot of opportunities in South Africa, and we've seen that in the last year in the markets here. So what we're saying is a proper strategy needs to be put in place, a global strategy that is able to straddle both the South African economy and the global economy. So what you really want to be able to do is take advantage of all the opportunities, both here and internationally. And I think for most South Africans, the reality is that they do have a lot of their wealth in South Africa, and as Carl alluded to earlier, it is slowly growing, where the allocation to the international and global markets is growing as families and high net worth individuals become aware of the need to actually internationalize their wealth.
Yeah. Okay, so if we just start engaging, what are some of the most common ways that we see South Africans taking or getting exposure in their portfolios to global assets?
So bearing in mind, I'm not talking investments. I'm not going to tell you what to invest into. I'll leave that to the professionals. I'll really look at it from a structuring and a bit of a tax planning perspective. And so the first way, and probably the simplest way is actually to invest in JSE listed companies that have international exposure, where they are, or a lot of their fee revenue or revenue is generated internationally. Similarly, what you can do is invest in a feeder fund in South Africa that as the name says, is it feeds into an international fund, and you gain access to the growth in the international assets inside that fund. I think the key here, really, from a tax perspective, though, is to realize that if you're investing in a South African asset, you will be taxed on that South African asset, which means, in this case, is that growth in the South African asset might be made up of two things. It could be made up of the actual growth in the international asset, but also the currency fluctuation between the rand and the currency that asset is denominated in.
Okay, so in practical terms, if we've looked at what's happened over the last 10 years, where you've had a weakening rand and a strengthening stock market overseas, you would have had a double whammy on your tax effect, essentially.
Yeah, exactly. So, it is something that is an easy way to do it, to get that access, but I guess there are other ways of doing it, and we're going to go into those now.
Yeah. So on that, as probably most people, at some point you want to take assets and invest offshore directly in hard currency assets. So own a US dollar, euro, pound, or some other currency asset. So again, what are the main ways of going about that? And I know we've got to be aware of the single discretionary allowance, your foreign investment allowance. So maybe just talk us a bit through that and how, the different ways of accessing assets offshore.
Okay, so first of all, as you say, you need to get your money offshore in order to be able to invest. And you've got your 10 million rand foreign investment allowance, and on top of that, you've got the 1 million rand discretionary allowance. I think the other one, which I'll touch on quickly now, and we can come back to it later if you want, but if you have no allowance left, you've used it up, or you can't access it for some other reason, there is the ability to use a financial institution's asset swap capabilities, such as Sanlam Private Wealth. But if we go back to just taking your money offshore, now the money is offshore, and you want to invest directly in these assets, you can simply from there go into the various assets that you want to go into. But you do need to be aware of the tax impacts, because as South Africans, we are taxed on our worldwide income. So no matter what you do on the other side there, you're still going to get taxed in South Africa. And I guess the big difference here between owning a local share with foreign exposure is that you will own now a foreign share. So you take away the currency fluctuation, and all you're going to really get taxed on is the actual growth in that share.
Yeah, initially.
Yes. Yes. Yeah.
Okay, but if so, maybe let's just talk through that. So if I'm, as an individual, decide now I want to go and buy Apple stock or a fund offshore or whatever other asset I might want to, what are the things I need to think about before I go do that?
So I think, you started with the introduction to say, it's imperative to go and get that expert advice. And that's not just tax advice, which is key, but it is also other types of advice in terms of structuring and other things like that. So you need to be aware that once you're going offshore, that you are exposing yourself potentially to taxes, ongoing taxes from South Africa, and potentially also you're exposing yourself to taxes in other jurisdictions.
So maybe take us through one or two of those examples. I mean, if you talk about other taxes, what other taxes are you referring to there?
Okay, so a good example is estate duty or inheritance taxes, it might be called in other countries. Now, if you are a South African, and you're a South African tax resident, you will be exposed to, on death, inheritance tax in South Africa of between 20 and 25%, depending on the amount of assets that you've got. Now, if you have a direct equity portfolio, for example, in the US, and it's made up of mainly US equities, you are potentially exposing yourself to inheritance tax in the US too, or the UK for that matter. It doesn't, the same applies. Now, what you would need to check is, first of all, does South Africa have a double tax treaty with the country in which you're investing into? Because if it doesn't have a treaty, you're potentially exposed to double tax. So if it's 20% inheritance tax here and 40% there, you might actually be exposed to 60%. But typically with the most developed countries and areas that we do invest into, there will hopefully be a double tax treaty in place. But what that means is that you don't just pay the South African tax, you're actually going to end up paying the higher of the two taxes. So if it's 25% here, but 40% in the US, if you haven't structured yourself properly and you've just got a direct equity portfolio in your own name, you're potentially opening yourself up to a 40% inheritance tax.
So, I mean, your leakage at a liquidity event in the future could diminish a large part of your return you've generated if you don't get your structuring right.
Yeah, absolutely. And I guess the problem is that going into a direct equity portfolio in your own name is the easiest and simplest thing to do. And upfront, it's the cheapest. And I think most of us, when we get started in the investment world, we go and we open up an account in our own name and away we go. And, if you are able to get that advice right up front and you are able to hopefully gauge that you're going to be making a lot of money through this investment process, getting your structure right up front is absolutely critical.
And I think that's something we saw during this whole lockdown period. I mean, you just have to pick up the newspapers or read something on the internet, I suppose, nowadays, rather than pick up a newspaper about the amount of online trading that took place during COVID. So it's become a global phenomenon, as you say, probably an easy access for a lot of people.
Yeah, and from our experience, I've also got a good example there where we had a family that many years ago took out a portion of their wealth and they split it between the family members, the mom and dad and the kids, and they each took out their allowance money and invested it in a portfolio of assets, and it did incredibly well. And over the years, they grew that asset base in multiples. And then they came to us. They realized that they had not considered things properly at the beginning, and they came to us to start speaking and find out what it was that they could do. But essentially what they'd realized was that they had two major problems. The first was they had a direct equity portfolio offshore that was literally pregnant with capital gains. So if they wanted to access those funds, they were going to be paying heavy capital gains tax back in South Africa. So they realized this and they looked at this and they thought, well, that's also going to continue into the future. So we've got this problem now, but if we leave it, it's going to carry on and just get bigger and bigger and bigger. And then the other thing that they realized was, they had 4 family members that owned these various portfolios. So if one of the family members was to pass away, they would suddenly get hit with this huge inheritance tax. And because a large percentage of their equities that they were invested in were US equities, it was going to creep up very close to the 40% mark. So what they did and what we did with a number of different advisors is we sat down and we went through what their objectives were, what they're trying to achieve, and really where they can go from here. And to cut a long story short, the end result was they decided to actually sell that entire portfolio, pay the capital gains tax in South Africa, and ship it offshore again in a proper structure. And in this case, they chose to go the offshore trust route, to lend it into the offshore trust. And I think what was quite interesting there, and the lesson that I certainly learned there, was that they recognized that they'd made a mistake. And as a family, they sort of held a family council and they decided that they needed to fix this mistake so that they could, from that point forward, move forward with the right structure. And again, that example also comes back to, get the advice as early as possible. Because I bet they're wishing that they had have got this advice 15 years ago.
Yeah.
And they would have avoided that problem.
And then maybe just one more thing on the direct assets in your own name. So, I mean, a very common way people go about this is to buy a fund or a collective investment scheme offshore in their own name. Now, maybe just touch on that in a bit of detail. You can maybe touch on that and the property stuff. Can maybe deal with that together. We always hear this term called probate. Maybe just explain what probate means and what the potential hazards are there, and also the complexities of jurisdictions. Sorry, it's a very complicated question, but I'm sure you can.
Well, I'll answer the parts that I can, and you can direct me if I haven't answered everything. But yeah, I mean, Probate is essentially the process of recognizing the executor of a trust or will, of a will in a foreign country. So you can imagine if you've got an Afrikaans will and the executor's Afrikaans, and you're trying to prove to a European country that you're the executor of this will, and they need to empower you to be able to deal with the assets in that country. It's not an impossible process, but if you don't put an offshore will, as an example, in place, that process can become very complicated, drawn out, and expensive. And where you're possibly looking at descendants that are waiting for this estate to wrap up and pay out, it can be quite a painful and expensive process for them.
And we've seen examples like that with our clients, where you've got certain up to months where you're dealing with foreign lawyers, and a big, as you say, becomes quite a costly exercise.
Absolutely, and you mentioned funds, and you need to check on the fund, but a lot of funds are able to circumvent these circumstances as well. They have recognition in the country in which they have set up that probate will not be an issue for them, and the funds will be able to come back to the estate without any hassle.
Okay, so again, that's where the advice component is critical. As we said, we're going to repeat that a couple of times tonight. So,
yeah, absolutely.
Maybe just touch on the property. I know I got through quite a couple of things in one. Just property in your own name with some of the jurisdictions you invest in that could cause some complications people aren't always aware of.
Yeah, I think property is always an interesting one, and I would say up front, you need to deal with property on a case-by-case basis, depending on which country you're investing into, and what kind of property it is for that matter. So, for instance, if you were wanting to buy a property in Mauritius, you would need to be careful of the forced heirship rules there. Now, that is a French-based rule, and basically it says that they're not really going to look at your will. They are going to impose their own version of forced heirship rules. So that they've got a formula, and those people will get a split of the assets. Now, in your own name, there's no way to avoid these kind of things, but you are also able to mitigate these through various structures. And one of the structures that works incredibly well in that example is actually an offshore trust, but I think we'll get to that just now.
Yeah, I was about to say that's going to lead us quite nicely into the next two.
But just to finish off, the other side of that, where you have to use it as a case-by-case example, is that in that example a trust works really well. But if you are looking to buy a residential property in the UK, the rules in the UK have changed such that it's probably better to buy it in your own name these days and not through a trust.
Okay, so again, no simple answer on these things.
Never.
Okay, so as I said, this probably leads us into the next, probably second most popular category here is for people to go through some type of wrapper. So call it an insurance wrapper offshore.
Yeah.
As an example, the Glacier Global Life Plan that we have in the Sanlam group. So maybe just touch on that and what the advantages of going through a life wrapper, how it works, and why people would use it.
Yeah, and I think I'll just back up quickly, because there was something that I forgot to mention going in your own name, and that's making use of a joint tenancy agreement, or
yes,
a joint tenancy account, and that is effectively where you open a joint account with your spouse, and why it's a very simple solution, and it doesn't solve the problems, but what it can do is postpone the problem. So the example of estate duty and those kind of things, that. On the death of one, it takes advantage of the exemption between spouses. So that account can shift seamlessly from your name to your spouse's name without having to incur any estate duty or those kind of taxes. Okay. But moving on from there to the question in terms of the wrappers, what I really like about a wrapper is that it's quite a flexible vehicle. You can do a lot with the wrappers that have been designed these days. And you get some great tax efficiencies out of a wrapper. So, as an example, you can bring your tax rate down from 45% to 30% for income tax, and on capital gains tax, you can bring it from 18% down to 12%. And then there is a kicker at the end too. Is that actually on death it does form part of your estate, but you don't have to pay executors' fees on it, and executors' fees can go up to about 3.5%, so it's significant.
Yeah, Certainly, if you talk about large sums of money and you add that up, it's also got another
Yeah.
impact at the end.
So the additional things with the wrapper is it does sort out the inheritance tax issues in other countries, and it does sort out probate as well. And additionally, it gives you protection from creditors. So I think it's a great vehicle, and it has its right place as a structuring option for going offshore.
So for most people looking to do plain vanilla things, investing in a share portfolio, some type of investment portfolio, a wrapper is potentially a good option.
Absolutely. And even then, if you want to be able to structure that offshore, there is an option of actually creating what's called a dry trust or a dormant trust behind that and set it up as a beneficiary to that wrapper. So on death, the money does pass offshore. Yes, you have to pay estate duty here, but once you've paid the estate duty here, it can move offshore and it'll be out of the South African sort of tax net.
Okay, so a nice, neat solution to actually shift the money across.
But just to go on with your example of a nice, simple solution, now take that same client who's got a traditional investment portfolio, but he also wants to have a bit more than that. Maybe he wants to buy property in Mauritius or the UK or whatever it is, or he's got a private equity investment that he wants to go into, or even something like he's got an offshore business that he's busy setting up in the UK or somewhere else, and he wants to know where he can own the assets in that business. Now, a wrapper doesn't work there. The platform doesn't allow, on the whole, for you to own those kind of assets through a wrapper. And that is really where, a trust kicks in again.
Yeah, so, okay, it sets us nicely for this part of the conversation. So the offshore trust structures, I think there's been a lot said and confusion probably in the market about the benefits and the concerns around trust. So we can park the people who've got their views on local trust, but talk offshore. So there's concerns around cost, there's concerns around the benefits. Maybe just touch a bit on these things. At what point does an offshore trust become beneficial? I think you've touched on some of the benefits from the flexibility side. So at what point do you think for some clients, and I know you're going to have to make quite a couple of assumptions here, but at what point does it start making sense for clients?
So, I think first of all, a trust is a great and flexible planning vehicle. And it's, over the years, it's been looked at quite closely by various authorities around the world, and it might not be as tax effective as it used to be. Okay, and it certainly has tightened up quite a lot on the tax space. But a trust is a vehicle that's, it's perfect for the transfer of intergenerational wealth. So tax is just a small part of that decision-making process. And yes, whilst some of the rubbers come off on the trusts, they are still hugely advantageous. And, certainly where you're talking about larger sums of money, a trust will inevitably be part of the global structuring plan. And by that I mean an offshore trust. So I think there are quite a few things that a trust can do that certainly help the individual, but one of the most important things that you need to consider is, yes, a trust can do all of that, but how do you actually get the money into the trust? And that is key. And that's one of the things that you really need to consider. Like, where is your money currently, and how are you going to get it into the trust? Because there's a movement from what your sort of as is scenario to where you want to be, and you might have to sell various things, or it's stuck in local trusts, or it's in your own name, pregnant with capital gains, whatever it is. So you need to again get the advice so that you understand how to move from there inside a trust. And then there are different ways of getting that money into the trust. But for South Africans, the most common way of getting the money into the trust is to actually lend the money into the trust. Now, with 7C having kicked in full gear a few years back, you certainly have to make sure that you pay tax on the interest on the loan. So when you look at the cost of a trust, and you mentioned it can get expensive and it can get quite complex, and that's certainly very true. But you do also need to be able to factor in, the tax on the interest on the loan. I think the key here, though, is once the money is into the trust and it's loaned into the trust, the loan is essentially pegged at a certain value. And yes, there might be a little bit of interest that accrues, but now the growth that happens on your portfolio happens completely outside of your estate and in the trust. And if you've put it in the right jurisdiction, there are quite possibly no further tax effects on that money whilst it sits in the trust.
Okay. So I see you've I mean, that was quite I think a very well structured answer. The one part you've left out for me here is at what level do you think it starts making sense for clients?
I was hoping you wouldn't notice it. I think it's a difficult answer because there are there are two different ways that people use a trust. Okay, the first is if you are really using passive wealth and you're putting it inside a trust and just letting the trust grow over time. There, I would say really at about $1 million, you should be looking at a trust. You can start to look a bit earlier, but there is the cost and the complexity around it. But where that becomes less of a question is if you are, as we mentioned earlier, possibly setting up a business that's going to be owned by that trust. And actually the trust is going to be the vehicle that receives sort of the fruits of the labor of that underlying company. Now what you end up doing is putting a small amount of money into a trust, but you are really going to get huge benefit and dividends that flow into that trust. And if you back your idea and the underlying company behind that, then the cost of the trust really pales into insignificance. So again, it depends on the situation of the client.
Yeah. So Sam, I'm just starting to look at I know we're going to get into the question and answer session in a bit, but I'm starting to look at quite a couple of these questions from clients and some of the viewers out there. So certainly I think we've answered quite a couple of these, but I think one thing I want you to maybe, and I'm going to corner you here, so maybe a bit of an unfair question, because I know you're going to have to sit here and make quite a couple of assumptions. But if you had to compare these three, because we've spoken about these three avenues now, so investing directly in your own name, investing through a wrapper, and an offshore trust. So if you had to take a certain scenario of clients investing a specific amount, which you can run us through an example, what is the different outcomes you could potentially look at here? And I know it's fraught with traps here, so maybe just do your disclaimers and if you can just give us a bit of a high level thinking on that.
And I will put some disclaimers, and please don't anyone quote me on this, but as you say, there are a lot of different variables, a lot of very long-term assumptions that you have to make. But I knew you were going to ask this question, so I've tried to put an answer together for you. And really, for me, the important part here is the difference between what it could be over 5 or 20 years and using one type of vehicle to what it could be using another type of vehicle. And the range is vast. So what I did was I made a few assumptions. I said, okay, we'll look at a 20-year horizon, and we'll be very optimistic and look at a 10% growth per annum year on year for 20 years. But there are a few other assumptions that I need to make. And one of those is that in this scenario, I'm looking at the owner of the money or the owner of the assets will ultimately die. So inheritance tax and estate duty has kicked in at the end of that period. And I want to do that so I can compare apples with apples, because like I said, with that direct equity portfolio, the sting's in the tail. So you need to look at the tail to be able to compare it properly. Obviously, I've factored in the cost of the wrapper and the cost of the trust and the tax on the interest on the loan and all the various tax savings that come along with those kind of vehicles, compared to the some of the disadvantages with a direct equity portfolio or something like that. So I took an amount of $2 million, 20 years, 10% growth year on year. If you put that into a direct equity portfolio, you might expect to get back around about $6.5 million. Now, if there's that's assuming there's no inheritance tax in other jurisdictions.
And okay.
So
I was about to ask, is that all in the US or in the UK? Or?
No, so that's assuming that it's just South African inheritance tax.
Okay.
Now, if there is exposure in other jurisdictions, that can drop to around about $5 million. If you were to put the equities into a fund And again, here I have to qualify. It would just be one fund that you put into and it stays there for 20 years. You don't sell the fund at any point in time, but obviously the fund can buy and sell shares in the background or investments in the background. But the fund stays the same. So in that scenario, that could grow up to about $7 million.
Okay.
All right. If you use the wrapper, and you've got these smaller tax savings or better tax savings over time because the tax rate's slightly less, so that compounds over time, and you could be looking at around about $7.5 million. Okay. And then finally, if you went to something like the offshore trust, and again here, huge assumptions that the interest on the loan stays the same, which is nice and low at the moment, so the tax is still looking quite good, but that could come out at between $8 and $10 million. And the reason why the range there is so big is I kind of had to show you the two alternatives. So it'll be closer to $8 million at the end of that period, you close down the trust and you paid out all the money to the beneficiaries. But if you decided to keep the trust for the beneficiaries, then the money inside there would stay at the $10 million because you haven't distributed it out and paid that additional tax at the end.
Okay, so material difference is, depending on the circumstances, with
Look,
a lot of assumptions in there. So
massive qualification around that, but the situation can change from amount to amount and example to example. But you're certainly, when you're talking about amount like $2 million, you really need to be bringing a trust into play there at least to consider.
Yeah, and as you say, there's many factors to consider around beneficiaries, long-term goals, all those things. So, Nick, maybe just before we get into the question and answer, because we've got quite a lot of questions coming through, and just looking at some of these, I doubt we're going to get through all of them. So I'm going to apologize to the audience in advance. We'll definitely answer a lot of these because some of them are extremely technical from a tax perspective. And over the next two webinars, we're gonna definitely touch more on very specific tax things with Stanley and Anton. But anything just before I get to this from your side, just a closing remark before we get to these question and answers.
I think I'm pretty much done on that side, but I can't miss the opportunity to give a bit of a shameless punt and to say that at Sanlam Private Wealth, we certainly have all the capabilities and key skills in place to be able to provide this kind of end-to-end service, from asset management, advice, all the way through to the structuring offshore and the funds that are available offshore.
Okay, no, thanks. So maybe I'm going to turn to one or two of these questions before closing. So maybe, I don't know if this is a question that you're going to be able to answer here, but can your children be included in the joint tenancy agreement if you're married, or is it limited to the husband and wife?
Yeah, it's a good question, and I'm not 100% sure on the joint tenancy, but my guess is that yes, they can, but you don't get the spousal exemption, so it actually doesn't.
Okay, from the tax. Okay.
Yeah, so it doesn't actually make a big difference.
You got a limit of 50,000 or something donation.
Yeah, that's yeah.
Okay. All right, so that's definitely something we'll come back on. I had an interesting question here because it's something we've seen a lot of is clients taking their living annuities, and because you don't have the Regulation 28 restrictions, and they're actually taking, for people that don't use as their sole source of income, they're taking 100% of that living annuity and they're shipping it offshore. So the question on that one, which is the easy one for you to answer, is in that case, do you avoid any of the US and UK inheritance tax issues?
I'm actually not too sure on that answer. Do you know that?
I do, and the simple answer is yes, because the owner of the assets is obviously the RAP in South Africa, the pension structure. So all those monies have to come back to South Africa, so it shouldn't form part of any of those issues. But that's something I was hoping you were going to give me a simple answer.
No, that's where I rely on Stan and Anton.
So there's a lot of questions on the 7C interest on loans, and I think what some of these questions, and I know probably quite a technical one again, but what is the deemed interest typically pegged on these 7C loans? What's the guidance? I know that it's a bit of an open question, but
yeah, and You know, I'd prefer Anton to answer those kind of questions because and Stan, because that really is their field. But typically, from what we've seen, and I'm not a tax advisor, but I work with tax advisors all the time in order to get the advice for these different types of structures. And what we really have seen is people use LIBOR plus 1 or LIBOR plus 2% as the range that they use when sending a loan off.
Yeah, so
And that depends. They can, it depends what currency it is, but the rate is LIBOR plus 1 or LIBOR plus 2, and typically on the 12-month LIBOR.
okay. And so typically something that has to be more market related at the end of the day.
That's exactly right.
Okay. So you using a trust with a large loan account owed to you as founder. So I mean, you've put the loan the money across to the trust. When you pass away, your estate will have a claim against the trust.
Yeah.
So this planning has estate duty implications. So maybe just some comments on that.
So again, I think this is a great question that we can leave for Stan and Anton, because they'll certainly touch on this. But what often you do is in your will is you actually cede that loan back to the foundation.
Okay. All right. So I think, look, from my side, I think we're quite close to the end of the webinar now. So firstly, thanks from our side for joining. We are going to have another session on the 29th where we're going to delve a lot more into the tax and tax planning around these things. I think a lot of these specific and technical questions we're going to delve into in a bit more detail. But from our side, I think what we've tried to illustrate here tonight is not that there's a one-size-fits-all or a simple answer. There's certainly you need to think when you go offshore. We know it's the right thing. You need to look at offshore investments, but just get your planning right up front. Speak to your financial advisor. Speak to your portfolio manager at Sanlam Private Wealth and get the right advice around these structures. And certainly there are ways of mitigating these issues. A key thing is mitigating any liquidity events where you're going to lose a lot of your returns that you've gained in your investment portfolio. Nick, from our side, thanks a lot. I don't know if there's a closing remark from your side on this.
Not really, Reg. I think just thank you very much again for the opportunity, and hopefully we'll see everyone at the next webinar.
Yeah, and everyone, please stay safe. I know we all getting concerns about this third wave. Hopefully it'll be a shallow wave, but we look forward to engaging with you again in person soon. Thank you.